In this video, let's talk about real estate investing from a risk perspective. There's a lot of people who don't get started investing in real estate because they think it is risky. However, if we cover some of the different risks in this video today, I think you'll have a better understanding of how real estate investing works and if it's really that risky or if you really need to worry that much about getting into it. So starting off with risk number one, I like to call this the equity versus debt decision. So equity being paying more upfront in terms of cash for a property as opposed to taking out more debt. So anytime you analyze real estate investments, you want to factor in how much debt you're going to need to take out to be able to buy the property. If you're in a financial situation where you have plenty of cash on hand and you can just buy a property all cash and not take out any debt, this is substantially going to lower your risk because now you don't have a mortgage payment to worry about every month. So you don't have to stress about missing that mortgage payment and it affecting your credit score or affecting the fact that the bank could take the property and foreclose on you. So again, having a mortgage-free property is a lot less risky than having one with a mortgage. However, for most people, we don't have enough funds on hand to buy properties with cash. So we would never be able to invest in real estate because we would never have that much money to be able to buy it all cash in the first place. Since we might have our own personal home we're paying for or an apartment we're paying for, we just don't have a way to save up and make a ton to be able to buy rental properties all cash. So in most cases, you have to go to the bank and utilize a mortgage, take out a loan to be able to buy the property. So this is where we need to start assessing how much down payment we're going to need to put down to lower our risk level to the point that we're comfortable and that property is making us a healthy margin. So what I mean by healthy margin, how much income are we actually taking home? What's our take-home pay after we subtract all our expenses and that mortgage payment? So if I look at different rental properties on the market, I can see that they're going to be priced at different purchase prices. So obviously, going with a lower priced property, I'm going to have a lower mortgage payment. For example, if I buy a $50,000 house and I take out a $40,000 mortgage, I'm going to have a smaller mortgage payment on that $40,000 mortgage as opposed to having a $90,000 mortgage if I bought a $100,000 property. So you can start off by assessing what your goal is in terms of your risk level. You can figure out a healthy price range to look for properties in so that you don't take out too large of a mortgage that makes it uncomfortable for you to invest in real estate. So analyzing the market, you might find that one property rents for $1,500, another might be able to rent for $1,400, but the property that rents for $1,400 might have far less expenses and therefore it brings home a bigger take-home pay. So this gives you more safety, more margin of buffer because you can start taking home more money every month into your rental savings account and that account will build up quicker. So the times that you do have repairs that pop up like a new water heater or maybe you got to hire a plumber to come out and fix a plumbing problem, you'll have this money in this account and you won't stress that you're going to have to come out of pocket personally. You can just pull from the funds you've set aside from saving money from your rental property income every month. So again, your stress level will increase, your risk will feel riskier if you're going into a property that has high expenses and the net income is much lower as compared to another property where those expenses are lower and you have a higher net income. So make sure when you're doing your due diligence, analyzing properties, you're finding properties that fall within a healthy take-home pay margin so that you don't get to the point that your expenses are cutting it too close to your income that's not leaving you much take-home pay. This will then make it harder to save money and have money on hand to cover repairs that pop up in the future. And this can make it riskier as you may have to come out of pocket and fund those expenses yourself out of your personal income. All right, so our second type of risk to consider is the condition of the property. So we've analyzed all the numbers of a property and been able to compare different properties based on their numbers, but we also want to factor in the differences in the conditions of these properties. So condition of a property, I like to start off with thinking about the age of the property. If this home was built much older in time, it's 100 years old compared to a newer property, this could provide some aging issues like, things that have just structurally deteriorated since the home's been around a lot longer. So this may require more repairs and more expensive repairs to fix bigger items like structural things that have gone wrong due to the age of the property. So condition of the property, you can start with age, how old is the property, and can give you an idea of what kind of risk you're getting into in terms of the age of things in the home. So I like to start by looking at the different mechanicals in a home. How old is the furnace? How old is the water heater? How old is the plumbing systems, the appliances, the roof on the property? This gives me an idea of the lifespan that might be left and how quickly I'm going to have to come out of pocket to fix these things if I'm buying it as like a rental property, for example. You know, in year 5, I'm going to probably have to do the roof. In year 7, I might have to do the furnace. In year 3, I might have to do the water heater. So getting an idea of the age of the different systems of a home can help you determine the condition it's currently in and what that's going to look like on the financial side in terms of how much you're going to have to come out of pocket in the future to cover fixing these types of items. So if you are comparing two homes, one home might have lots of new things in it, one home might have lots of old things in it. So the old home's probably going to have more expenses that pop up than the new home, for example. Now, on the flip side of this, a lot of times your more distressed homes, you can buy them at a cheaper purchase price. So there's opportunity to create value, which means you can create more income or more profit, and this could outweigh the risks of those expenses since you're going to end up making back more money from this property. So you need to kind of consider the risk reward there. Some conditions of the homes matter in terms of if you're flipping houses, you want poor condition homes. That way you can fix them up and sell them and make money as a profit. But on the side of the rental property, if you're looking at condition, you might want to go with maybe the newer home since it's going to have less issues pop up over time, and that's going to keep your cash flow coming in on a consistent basis, not having to worry about paying for all these repairs all the time, sucking money out of your rental income. All right, our third type of risk to consider is strategy. So a lot of investors want to know, is it riskier to do fix and flips? Is it riskier to do rental property investing? And personally, I think they both have their risks, but I can't say one's riskier than the other. However, the one risk with fix and flips is it's a short-term kind of timing of the market, whereas rental properties you're holding long-term, you can weather the storm. So what this means is if home values start to decrease, fixing and flipping becomes more risky because you're trying to get in, fix it up, and sell it at a price that's higher than what you paid for it so that you can make a profit. But if home prices are going down, that affects how much you can resell it for, and that starts cutting into how much profit you make. And it can make it risky that the home might go down below what you need to break even, and you could end up taking a loss on the property. But with rental property, it's long term. You're going to own it many years, so you have the ability to weather the storm. If property values are going down, they really don't matter to you because you're still renting the property out, collecting rental income. You don't have any plans of selling it right now, so you don't really have to worry about taking a loss on the property since you're not going to sell the property. You can sit back, collect rental income, make money on the property, and not have to worry. Now down the road when you get ready to sell, then it becomes more of a risk as far as when's the best time to sell. You want to make sure you're getting out when the market's strong so you can get max purchase price and you can get a quick sale and not have to let it sit for a long time where you have to keep paying expenses on it. So what are some risks with flipping houses? Well, number one, if you overestimate how much you think you can sell it for and you come to find out the market's not there and you end up having to sell it at a lower sale price, and this cuts into your profits. Number two, underestimating your repair costs, going in thinking you have this certain budget in mind of how much it costs to repair the whole property and renovate it, but then you get in there and you find unexpected things and this jacks up the renovation costs and ends up cutting into your profits. And then the third risk is getting out of the property quickly so that you can buy the next one. A lot of times you might find that the market dynamics matter when it comes to reselling the property. And if things have shifted, you might get stuck holding the property longer. It might take longer to sell, and this cuts into your profits because you have to continue making those mortgage payments every month. You have to keep paying the property taxes, the insurance, the utilities. So you're losing money every time this home sits on the market longer and longer and longer, compared to if the market was hot and you could just get a quick sale nice and quick. So with rental properties, some of the risks include how rentable is the property. So if you picked an area that might be tough to rent in, or maybe the property itself is just not attractive to people. They don't want to rent this property and it makes it harder to find a tenant. So you need to keep that in mind. That's some risks of renting out, finding a tenant, keeping it occupied. There's vacancy risk there because every month that sits vacant, your not bringing in income, and you still have all these expenses you're on the hook for. So you have to fund those expenses out of pocket until you get the property rented, and then you can use the rental income to pay for those expenses. So the risk there is having extra money on hand to make sure you can cover the operating expenses to own the property while you're waiting for it to get rented out. So picking an area that is in high demand for rentals will help you make sure that this property then has a higher chance of getting rented quickly. Some other risks with rental properties is getting a bad tenant into the property. So you may get it rented quickly, but then find out this tenant's not a good tenant. They don't pay on time, they damage the property, they're just a pain in the butt to deal with, they don't listen to the lease, and you have to take them to court and sue them for things. So making sure that you're screening quality tenants. So tenant risk is another thing to consider when owning rental property. Another risk that you need to consider, which we've kind of already covered, is the condition of the property. So you always run the risk that things are going to go wrong with a property as you own it over time. So the furnace could go out, a leak could happen in the roof where the property gets damaged inside the home. So these are risks that you need to consider when assessing a property, having inspections done to make sure you understand what you're getting into before you buy it. And then the final risk when investing in real estate is the cost of capital, or the opportunity cost, I should say. So you have money, you could buy rental properties, you could buy fix and flips, but you need to weigh the costs of what you're giving up by putting that money into this property. You could be instead investing that money in other opportunities like the stock market or bonds or different private investment opportunities you might come across that people tell you about. So there's always opportunity cost as well. That's a risk that you might end up getting into a bad real estate investment that loses you money. And the cost there was you could have took that money instead and invested it in like a stock in the stock market that would have done really well, and you would have made a lot more money. So that's opportunity cost, opportunity risk that you need to factor in as well as a decision when deciding between real estate versus other investments. So overall, those are some of the different risks to consider, making sure your equity versus debt ratio is appropriate so you don't over leverage and take on too much debt that it stresses you out having to make these bigger mortgage payments every month. Also looking at the risks of strategy, whether you flip houses or buy rental properties. And then opportunity costs, making sure you're looking at other alternative investments and comparing the risks of those versus real estate, because you're going to tie up capital. So you want to make sure you're picking investments that you get the best return on your capital relative to the risk level that you're taking on. Overall, I don't think real estate investing can be that risky if done correctly, where you assess all of the different things correctly and make the smart decision based on the information you gather. So again, get a lot of information on property values, rental values, get information on repair costs, have home inspections done, talk to professionals to get their opinions. This can help you make better informed decisions, and this will help you reduce your risk.